is the sexiest part for the limited partner, depending on what they're trying to complete.
Thank you so much for tuning into Journey with Christian D. Evans podcast. I'm your host, as always, Christian D. Evans. This master of scaling in heavy lift apartments is my next guest. He also focuses on build to rent and value add multiple family syndications. He's a force to be reckoned with in the real estate world. That's why I'm having him on my podcast. With his podcast, The Capital Raisers Show, he showcases an interview-based thought leadership and crafts content to help syndicators raise capital with finesse. And then he is also from the joint venture acquisition to establishing a co-GP partnership. His expertise knows no bounds. When he's not busy co-authoring a book or presenting prestigious events, please welcome, you can find him on various podcasts spreading his wisdom and marketing capital raising fun, rewarding journey. Let me start this thing. I apologize. I totally messed this up. So I want to make sure I get this correct. Guys, the team, go ahead and delete that last bit. Thank you so much for tuning into Journey with Christian D. Evans podcast. I'm your host, as always, Christian D. Evans. And guys, we have a very special guest on today. He's the master of scaling in heavy lift apartments, built to rent and value add multifamily syndication. He is a force to be reckoned with. That's why we're having him on our podcast in the real estate world. With his podcast, The Capital Raisers Show, he showcases interview-based thought leadership and crafts content to help syndicators raise capital with finesse. From joint venture acquisitions to establishing co-GP partnerships, he shows his expertise knows no bounds. When he's not busy co-authoring a book or present as prestigious events, you can find him on various podcasts, spreading his wisdom and making capital raising a fun and rewarding journey. Please welcome my next guest, the managing partner of Legacy Acquisitions, my wonderful guest, Ruben Greth. How you doing today, Ruben?
Christian, I feel like $1 million, especially after that intro. Wow, man, it's like I feel like Superman now. Very cool, man. You got the radio voice going on. This is going to be a blast. Thanks for having me on.
Well, Ruben, I am looking forward to this conversation as well. And what I found so interesting before we got on this podcast, there's a ton of people that talk about real estate and different kind of verticals. And what I found very interesting is offline, we were talking about, we really want to dive into kind of that build to rent kind of aspect. You've really been able to niche down in that, and you've been able to dominate that. And that industry, there's certain KPIs, there's certain metrics. But before we dive in all that fun stuff, which is going to be fun, I want to ask you, what has been your evolution or your journey in getting into that market specifically? What did you find? What were those pivot moments that helped you get into that moment?
So first, I'm not an operator. I'm more of a capital raiser, equity provider for our builders, right? And that's where I spend the majority of my time in that space, raising money, marketing, creating exposure, creating a national presence. So I got my start in raising capital for small multifamilies here in Phoenix, is where I'm from. We did a bunch of fourplexes back during the real estate crash. What a phenomenal time to buy. I wish I still owned all of that. Don't wait and buy real estate and wait kind of thing, right? Because everything it appreciates incredibly. So I actually split up with my multifamily fourplex partner back in about 2012 and left real estate altogether for a while. Tried to get back in as a investment sales kind of guy, being a realtor for investors. That didn't work out too good. So I interviewed some syndicators and asked, how do I get into this space? Who do I need on my team? And they're like, well, what do you care? And I'm like, well, I used to raise capital for multifamily. I like marketing. I want to build a team and get into this so I can scale. I haven't wanted a partner recently because I had a bad breakup, but I understand that in order to scale, I have to partner with people. So who do I need on my team? And they're like, wait a second, you used to raise capital? We need somebody like that. Come join us. So instead of going to a guru program and paying whatever $15,000 to $50,000, which is what the full encompassing multifamily programs cost, I became an apprentice, learned about raising capital specifically for syndications, which is a different kind of capital raising than joint venture capital raising. And in the process, I read in a book by Joe Fairless that it makes a lot of sense to create an interview-based thought leadership platform. And if I was going to do that, I figured I might as well do it on the topic and subject that I want to master, which is capital raising. So I launched the Capital Raisers Show and then learned about limited partners and raising capital from all kinds of sources, funds, institutional capital, family offices, preferred equity, the list goes on, and kind of opened this entire universe of capital raising up to me. And the guys that I was partnering with, they're like, well, so we brought you on to raise capital. Where's the capital? And I'm like, well, I don't have any relationships with people. I can't just raise capital. But they're just like, we brought you on to raise capital. We have a deal that's closing in 90 days. We need the money. I mean, do something. So I was able to create some solutions there through co-GP partnerships, which is when you bring on a person that's got an existing database. Perhaps they want a greater general partnership role in a deal, and brought in a couple of $1 million through co-GP. They're kind of like JV relationships, but they become part owner of your company or officers of your LLC, and then they raise from their databases and get to partner with your track record or my partner's track record and kind of enter that game or scale their game in that capacity. So we did that for a little while. And then through the show, I found out about funds, and all I had access to was Arizona deals. And I wanted access to all these special, crazy syndicators deals. And they were all over the country, particularly in the Southeast. So I decided to launch a fund. And then one of the people I interviewed, they came to me and said, hey, instead of launching your own fund, there's going to be all kinds of barriers of entry, including people asking you, well, how many of these funds have you created? Why don't you just partner with me? I've created funds. We can go raise capital for multifamily. And by the way, I have this thing called build to rent. And I'm like, build to rent? I could never sell build to rent. I don't know anything about development. But as I looked at it closer, it was extremely lucrative for the limited partners, extremely lucrative for the general partners, for all parties involved. You had an impact, you had control, you could find deals where other syndicators couldn't because they were competing with other syndicators, and we didn't have to compete because most people don't want to take the time to learn development. So for all these reasons, we doubled down on build to rent, and that's pretty much been our exclusive business model for the last, I don't know, about 18 to 24 months.
So it became almost because of your in-depth kind of research and analysis that became a defensible moat in regards to kind of your business opportunity. Because like you just mentioned, all those other verticals, they didn't want to do the homework. They didn't want to do the due diligence. They didn't want to understand the industry as well as you guys did in the build to rent space, which is interesting. You mentioned a lot there. Uh, what
Mm-hmm.
what were just let's step back for just a second in regards to the JV versus the co-GP kind of and direct and a kind of LP structure. What were some of the positives and the negatives of going both of those routes? And what I mean by that is obviously you and I know after talking with a lot of family offices and a lot of just high net worth, ultra high net worth, everybody has their own different investment thesis, what they're looking
Yes.
for, and so forth. And so sometimes it is hard to make that synergistic relationship in regards to the deal and the investor, making sure that you have actually not just committed capital, but actually deployed capital, right? And there's a massive difference. So what were you able to do to, facilitate those strategic relationships right off the bat and said, hey, we're closing this deal. We need money, right? Your managing partner
Yes.
was saying that. And you're like, okay, well, we got to figure out a different strategy because the typical LP structure wasn't working. You had to go for the co-GP structure. What did that look like? What was that? If you could dive into that a little bit further.
Yeah, investors have fear of missing out. And when you tell them we're going to close this deal with or without you, and then you do execute on your business plan, and then you come back and say, hey, now we're cash flowing astronomically on this deal. You want to partner on the next one? A lot of times they want to. The biggest differences between JV and limited partner capital, I think, is when you do JVs, it's a lot more profitable for everybody and there's less partners, but it's a lot harder to scale. So you run out of capital faster. And if you really want to get into 200 units and above, then you need to have more people associated with it. And those are kind of the major differences that I've found so far, is that with joint ventures, you only have a few partners. It's more lucrative, but it's harder to scale versus with LPs or just doing syndications in general. You have access to larger capital sources. And we can kind of dissect, would it make sense to get 400 LPs versus one single check writer from a family office? Because those are completely different animals and ways of investing as well.
Well, what I find, and you mentioned this, you went out and try to find synergistic relationships. So you knew legacy acquisitions were really good in this kind of analysis, maybe deal flow, and then the other, kind of relationships, co-GPs, if you will, they were really good at maybe the LP base, right? They had a huge, pool of investors, et cetera, that they could pull money very quickly in a short period of time. Is that kind of how you were able to find synergistic relationships? And is that kind of always how you've always thought?
So I don't know if I was specifically targeting relationships. I mean, I knew that if I just went out and made a bunch of friends, some of those people would become partners. That was kind of my philosophy around it. But I didn't go to Andy and say, "Hey, I want to do business with you." It was the opposite. I interviewed him on my show, which, as you know, podcasting is a phenomenal way to create relationships and have longer, more in depth conversations where you can add value with the podcast host. So a lot of people were seeing me having the Capital Raiser show. They wanted exposure. A lot of syndicators are great at business models and acquiring properties and executing business plans. They're not always so great at marketing and exposure and automations and systems. So when you can partner with somebody that's really great, they see benefits in working with you because you have a skill set that they don't have. And for you, like in my case, I didn't have a bunch of money to go launch a fund. So if somebody could provide the capital to pay for those kinds of things and then let me kind of stay in my lane and focus on what I'm really good at, it really was a no brainer for me in terms of decisioning. But in terms of creating relationships, the first key to it is, I think, to get out there, to expose yourself, and then become friends with people. Because if you look at, my friend Dan Hanford likes to talk about the know, like, and trust triad, investor triad, what he calls, and he says people can't ever like or trust you if they don't know you. So you need a platform, you need omnipresence, you need to do networking, you need to get out there, and that is one of the greatest ways, if not the greatest way, to start building relationships, is to have that omnipresence and do a ton of networking.
So big, so big. And I'm curious, kind of looping back in regards to when you're looking at these deals, how do you find the right synergistic LPs or investors that are looking at that? Because like you and I, we just mentioned, the each investor has their own investment thesis. Some go for just they got different strategies, right? And that's really what it comes down to. And it really is very contextual depending upon where they're at, what they're looking for, etc. So how do you do that? Do you focus on reaching out to your kind of your LPs and saying, okay, what are you guys looking for? And then go find that deal? Or is it kind of, hey, we got this amazing deal. It's sexy. It's attractive. Obviously, the company itself is going to make money. And then you got to go find the investors. How do you kind of strategically approach that deal flow side of
You
things?
broke it down perfectly right there. There's two essential philosophies when you're out there raising capital. You can either go to your database and ask them what it is that they want and then go provide them that, which is a lot better. I mean, if you are very good at creating deals and then you take it to your database and they're like, well, we don't want this specific thing, and that's the only thing that you have, it's kind of like you're shoving something down their throats. But what you can do, which is what a lot of capital raisers do, is they educate and nurture and add value, right? They get a big database, they explain the benefits over time, and it's a long game. It doesn't happen over an investor call. People typically don't call you and say, "Hey, I'm ready to invest $50,000 with you on the first call," unless they've been really vetting you for like a couple of years. Some of those people come out of the woodwork, but they've been watching you for a long time. They've been following, they've been studying the whatever niche it is that you're trying to raise capital for, and they're determining if they like and trust you, not only as an individual, trust you as an individual, but trust you as an operator. So there's kind of two levels of trust that you have to establish with them. But it can be very challenging. And, my philosophy is the same as a lot of other people. You educate and nurture people, and eventually people, if you get in front of enough, will decide, hey, this makes sense if your argument and your business philosophy is compelling, right? And we think that build to rent is a very compelling argument right now, especially with the lack of deal flow in the multifamily value add space.
So let's get into the build to rent, because I found this very interesting when we, and that's one of the reasons why I really want to have you on, not only because your ecosystem, your presence online, but also because you really niche down on this one specific vertical, and I'm not familiar with it at all. So let's, unpack the foundation of it and understanding obviously your defensible moat you kind of mentioned earlier on,
Mhm.
and really what you look for in regards to a successful deal and even just the underwriting process. So let's kind of start with obviously what is that, the foundation for our audience, and then understanding kind of what's so sexy about this vertical.
Yeah, let's address a couple of misconceptions first, because there's a lot of noise in the media and particularly in the news saying it's not a good time to invest right now. And other people are saying it's never a good time, or a lot of times it's not really ideal to be building. But every single building in your downtown and every multifamily property that's ever existed, it was built by somebody. And if you can get to the point where you can mitigate enough risks and execute a business plan and you have experience doing it, then development makes a ton of sense, because you've eliminated a lot of the problems that can happen throughout development. And of course, it's a crazy game where all kinds of unexpected things happen in all markets across the US. But let's dispel a couple of myths, right? So people think that builders are slowing down on developments, particular in houses. And there's one kind of development which is to build to sell houses. And there's another kind of development which is to create communities that you operate as one commercial real estate asset, and then take that entire asset of a bunch of houses, 100 plus houses at one time, and sell it to an institutional buyer that wants to cash flow in a brand new asset for long periods of time. So build to rent is not build to sell. And that's the first thing that people confuse, right? They think all developers are experiencing the same dilemmas, and that's not the case at all. The other thing that people need to think about is build to rent is very different depending on where you're doing it. In Phoenix, build to rent is a whole different animal than it is where we're doing it in the southeast, where it's positive migration, land is dirt cheap, it's literally dirt. And then, the cities are in pro growth mode, so they help you get entitlements and get engineering and get across the finish line relatively quickly. And then if you start implementing business models like, hey, we're going to put an option on this land and not complete that or exercise that option until we get the engineering approved, until we get the entitlements and zoning changes and everything and the density requirements established and architectural plans approved, then that kind of eliminates some of the risk that a lot of people are freaked out about, which is like in the early phases of development, land can be risky. Although, if you know what you're doing, it's a very lucrative part of that business model. So we particularly like build to rent, but we don't do build to rent all over the country. We're just doing it in one little sub niche of a certain state, or a couple of states in the southeast. And it is a very different animal. So a couple of things that we love about build to rent. I mean, the residents, a lot of times, particularly in today's market, they want to have a home experience because they don't want to live in an apartment with somebody above them, below them, to the left of them, to the right of them, across from them, and then a little tiny balcony. I mean, that's not a it's not conducive for growing a family, or if you just want to have people over and you have to make them climb 4 stories to get to your apartment. So it's the same as multifamily in the sense that it's got recession resistance. I mean, particularly if you operate it where you have a bunch of houses on one tract of land, all with one leasing manager and one property manager. So it's kind of like what we call horizontal multifamily. It's operated the same way a multifamily apartment complex is, except you get the benefit of having individual lots. A lot of people are very bullish on build to rent. There's a shortage of housing. There's massive demand from institutional buyers. So I heard this recently. Institutions own like 50% of all multifamily in the country that's 100 units and up, but they only own like 2 or 3% of the houses. So you're going to see that number increase significantly as these institutions come and buy all these subdivisions, but we can't, as builders, provide them with more than 2% of what they have ready to deploy into this particular industry, because they want the ability to have individual houses and the benefits of owning investment property, individual investment property, but they don't want to have scattered sites where they have, 5 properties on this block and 5 properties over here, and it's a nightmare to property manage. There's low maintenance on the homes, there's lucrative returns for everybody involved, like we talked about. And the residents, of course, get a backyard privacy fence. And we don't have to, what I really like is we have control over what the end product looks like. So we have kind of like the ability to make things beautiful and it control the resident experience to some extent. And we don't have to compete with a bunch of people that are not sophisticated enough to enter the development game. And you don't always want to do things that are easy because if it was easy, everybody would do it. So sometimes it's nice to have your hands in something that's challenging to do because you don't have as much competition from all the people that are like driving into flooding the multifamily industry or other industries that have a lot of people just looking to ride the wave of increased property values, which is slowing down significantly right now. So those are some of my original thoughts, my initial thoughts on build to rent. What do you want to unpack from that?
Yeah, there's so much, and I really appreciate first of all starting with the misconceptions, because huge point on that, and really kind of foot stomp on that. It's so nice to just go straight for that, because there is a lot of misconceptions in the market. I always find, and correct me if I'm wrong, I look at the build to rent almost like the VC market, where that risk reward, there's sure maybe a little higher risk, but the reward will obviously outpace that when you're working with and collaborate with individuals like yourself that are very good at really targeting and understanding and underwriting the deal, if you will. I'm curious, am I correct on that assumption in regards to that risk reward? Because in the build to rent, there are a lot of variables that are going on. You have to choose the place. You also have to go the right
Mm-hmm.
permits, all that stuff, as well as, there's a lot of variable cost associated. And there's other things that I didn't even mention. But obviously, as long as, so am I correct on that assumption, or kind of the way I'm thinking about that
The
risk reward?
name of the game in any commercial real estate investment syndication is forcing appreciation, and typically you do that through improving the net operating income or driving down the expenses. But another way to do it is through forcing appreciation by adding density, by changing zoning, by doing things to the land, by putting in streets, roads, sewers, utilities, all of that stuff. You're increasing the value at every single phase along the way. And you can sell at any given place along the way too. After you do things in the land, after you put in utilities, in the middle of building, you can have different exit strategies where you keep some, you keep all of it, you sell all of it. There's all these different places and ways that you can do this model or do building and development in general. But what I really love about it is the crazy amounts of forced depreciation and the control that you have to do things to make the property more valuable. So that's some of the stuff that I really love.
Definitely. Well, when you're looking at some of this, developing these deals, if you will, I
Mm-hmm.
always think about, my dad. He owns some real estate, and I always
Nice.
remember that whenever we do some capital expenditure on that, do whatever, right? You could fill in the blank, roof or whatever. We'd always find something. We'd always anticipate an estimation of maybe 5, 10,000, 20,000, 50,000 for that one house, right? And then for the roof or whatever. And then we'd always uncover and realize, oh man, it's going to add another 10,000 or 20,000 to the bill, right? To the bottom line. And what I realize is that's with anything in real estate, right? And in anything in life as well. When we start getting into it and unpacking it, we start realizing there's a big hole in the ground and we got to fill it up, and it becomes all these permits and all these things that are unnecessary. So it's the ugly side of real estate. And I shouldn't say the ugly side, it's just the ugly side of life, right? There's always downsides of it, but you got to anticipate that. And what I always found interesting is some of the best entrepreneurs and some of the best real estate individuals like yourselves as well, is you guys are able to have that room of margin, right? So when you're looking at underwriting a deal, okay, inflation, right? Cost of goods are going up, and they're constantly changing and adjusting, right, during this crazy time. So a lumber, used to be 10
Mm-hmm.
bucks, now it's 15, now it's 20. How do you guys look at these and underwrite these deals with the room of margin a little bit, for margin of error, to anticipate some of the variable costs or variable assumptions that are uh, in the deal?
Yeah, you have to stress test like a maniac. You have to have a ton of reserves, and you have to underestimate and do a lot of contingencies everywhere. So if you screw up something or if some unexpected circumstance happens, you're covered like in 5 different places, right? So you estimate the rents at 1450, and then the reality is you can get 1700. You say, hey, we're going to have all these reserves in place, so that way when the lender comes back and says, oh, we can't we can't execute this loan that we promised you because the warehouse lines were pulled, and you need to have more reserves, and then you have to go back to your database and raise more money to get across the finish line. Lumber prices change, construction costs change, supply chain costs change, cement prices change, right? All of that stuff changes. And I think some of the major differences with development is you have to be, I mean, particularly if you're raising from limited partners, be able to explain that this is like a rotational agenda and things are constantly moving in and out that are completely unforeseen and unexpected. And limited partners typically don't like that, right? So I think that's what freaks them out about getting on the ride for this, even though it's extremely lucrative and there's all these other benefits. And I think they understand this is where I should get in, but there's things that prevent them from getting in. And some of it is like, oh man, I didn't know that like you were going to find some Indian bones on that piece of dirt. And there's going to be an archaeological study that's going to increase, the time to build this thing out, and they have to be ready for those changes too. The developers are kind of used to it because they have to deal with that stuff on every project, like some unexpected thing. But to answer your question, we have to underwrite in such a way where there's incredible contingencies, and even estimate, hey, we're probably going to get a 14 or 15% return on investment on this particular deal. When the reality is internally as a group, you're probably going to knock it out of the park with a 25 or 30%, but you don't want to tell people that and then give them a 14% return. And then you give them those numbers and they're like 14%, that's the same as multifamily. Like multifamily seems a lot safer than development. Why would I invest in development? And you have to convince them, we're completely underwriting in such a way where we're going to knock these out of the park, but we're just not going to tell you that because we want to make sure that we overperform on what we're saying and what we project to happen. And here's why. We're saying that the rents are this. We've already built 8 houses and we know we're getting this. The underwriting still says this number that we originally underwrote at. But the reality is we know based off of this, we've already proven it that we can do this here and this over here. And, this amount of reserves are in place, etc. And you have to do that in so many places where if only a couple of those things don't hit, you just knock it out of the park because you've created contingencies and stress tested in so many different places in your deal, not just in a couple places.
Yeah, that's why it was so cool when you mentioned that you guys just only invest into one that part of geographic location of the United States, and those a few states. I found that very interesting because obviously that showed to me that you have a methodology of previous data, of other deals, of other data that you're able to pull off of and say, because we've done 8 deals in this area, in this very similar location, in this kind of structure, in this kind of same deal size, we're able to anticipate a better kind of and tighten those margins and those errors, just because obviously you have a very vetted methodology and vetted process. Is that correct?
Yeah. Yes. However, there's one, a lot of people ask us why those markets. And the reality is like, we have partners that live there and they're amazing. I mean, they create incredibly beautifully aesthetic properties. And then in addition to that, like the guy that acquires the land, he worked for institutions acquiring like $750 million worth of land, and he wanted to become a syndicator. So he partnered with his best friend from high school who had built like 250 houses. They wanted to scale into subdivisions instead of just continuing to buy houses. And they needed a capital infusion, and that wasn't their area of expertise. So they came to us. They're like, hey, look at these lucrative returns, what we can make, what we've done in the past. Let's kind of blow this thing up. So we like that particular. I mean, our guys live in the places where we're developing or are within a 4-hour radius of it. Now we're open to expanding into Florida and Texas and some other places that we really like. But the idea, and you mention it and make it sound like we have all this incredible expertise and track record, but we're doing our first three subdivisions right now, right? So our track record comes from other people on the team that have developed in other markets. It's having invested in multifamily for over 20 years on some of our team members, having the liquidity partners that have huge companies that they own, including lending companies, and our team, our builders. I mean, it's a team sport. And right now, we have the combined track record that's very compelling, but we're still on our first few subdivisions. So once we get through those, then we're going to have the ability to go to the world and say, look, we just proved this. We're not even inventing the wheel. We're just copying DR Horton and some of the other companies that are already doing the exact same thing in our markets, but we're just doing it a little bit better. And we're incentivized because as the builders, we are part owners. We're not just general contractors that have nothing on the line of just building some houses and then we're off to the next one. Like, we want to make these as lucrative as possible, so we're going to make them as nice as possible, and we're going to be invested personally in making these things the most beautiful properties for the best price on the market that we can generate, right? So these are some of the things that people are curious about, like why in these particular markets. Southeast is great, land is cheap, but I think the main reason is our team is there.
Okay, this makes sense, and that's why the collaboration and those synergistic relationships are extremely important, which you mentioned earlier on. I want to talk about the actual deal itself a little bit. You mentioned here when you guys are building this out, I would imagine you guys are looking at really building kind of a Class A real estate. I don't know how many units. We can obviously dive into that, but obviously, top market kind of rents, and that's kind of what you're aiming for when you're looking at underwriting the where you guys are going to build out, what that looks like, what are the averages, and then being able to say, okay, hey, because the value add is, buying something at Class B, putting $150,000 per unit, increasing it, taking the tax deduction, et cetera, and moving on, right? And then selling and flipping that whole thing, right? Of 200, 300 units. This strategy, though, correct me if I'm wrong, you guys are wanting to get kind of the higher end of the rents when you guys have an exit. We could talk about the exit. I just want to make sure I'm clarified on that.
Yeah, there's some pushback, better said. Occasionally I get people on LinkedIn when I'm talking about built to rent, including today. They're just like, well, this doesn't provide a solution to the affordability program, and people can't afford the houses. We're not building to sell to people that can afford houses in B class, C class kind of neighborhoods. While that's very philanthropic of you for wanting that to happen, what we're doing is trying to make our investors money and provide our residents with at least an affordable, almost A plus grade property that's brand new, that's got no maintenance, that gives them the experience that they want. If they can't afford a home and they're waiting for the rates to go back down before purchasing and they don't want to live in an apartment, well, guess where they're going to go? They're going to come to our built to rent subdivisions and have an amazing experience while they're there and probably stay for 40 months or longer. But it doesn't necessarily solve the problem of people can't afford where to live. And unfortunately, a lot of people that make $40,000 a year can't live in a luxury house, and that's the reality of the situation. And we can try and help them as much as we can, but people's own personal economy is their own personal economy, and we can take a subset of the economy and say, hey, let's provide these guys with the best product that we can and give them something that's absolutely beautiful and an experience that they love, and make our investors money simultaneously. But we can't afford every issue in the economy through what our business model does.
That makes sense. Okay, I just want to reiterate that. So that's really good for my audience to know. I also want to talk about the negotiation of the deal structure. There are different points and different phases and different stages of
Yeah.
the deal and the negotiation aspect. If you could, I want you to just kind of unpack that whole thing, because obviously there's a lot that goes into it. It's like an onion, and just kind of layer it out, and we can unpack that from there. The negotiation phases and the processes.
Yeah, let me mention real quick, in case there's any regulators or lawyers listening in, that we primarily do 506C investments to accredited investors only, so that we're allowed to have conversations about our projects on podcasts and go on social media and talk about it and stuff. But primarily what we want to do here Actually, could you repeat the question again? I wanted to throw that in there and it kind of
Yeah,
derailed my
no,
thought
no, that's
process.
perfect. Yeah. So the question really is, and I appreciate you mentioning that, but one of the questions is really focusing on kind of the negotiation of the deal, right? The phases and the stages
The
of that and the
phases. Okay,
evolution of it.
cool.
Yes.
So
Mhm.
there's different risk profiles at each phase. And for depending on who you want to target, we brought this up a couple times. People have different risk profiles that they like. Some people want cash flow, some people want back end equity and partnership, and certain sub niches of multifamily or commercial real estate will provide different goals for different people. But within the risk profiles of the, I would say, every developer has their own phases of development. But in my idea and my perspective, there's three main phases. There's like the land and acquisition of the land phase. There's the infrastructure stage where you're you've got your engineering approved and now you're putting in streets and sewers and sidewalks and that kind of stuff. And then there's the vertical construction of the houses. So like once the slabs are all laid out and utilities are connected, then you just build the houses vertically. And those are the three phases. Now, when we're raising capital, we're typically not doing it at the land phase right now, although we probably will start a fund that invests into the hybrid, all three of those phases. But for now, we're doing it individually. We're taking down the land and mitigating the risk by purchasing it with our own cash. And then we raise from joint ventures typically for the land phase, or a lot of times we will for the, I should say, horizontal phase. So we need money in order to improve the property and force the appreciation. So let's say we go and raise $2 or $3 million to put in sewers, streets, and whatnot. By the time that that property has all of that stuff completed, it may be worth $6 or $7 or $8 million. And when we're completing the last phase, that's when we syndicate. We go raise from limited partners a lot of times. And then that's the fastest time for the investors to get their money back. And it's the least risky. So that specific risk profile, if you're trying to eliminate the risk, but you like development and you like the possibility of owning these long term, in some cases, that last phase, especially if it includes long term ownership, is the sexiest part for the limited partner, depending on what they're trying to complete. But if you're just flipping it like we are to institutional investors that want to buy the entire subdivision, we syndicate the vertical development. We build the houses about 10% a month. I should say we start 10% a month. So if we have, let's say, 100 unit subdivision like one of ours, we build 10 houses. We start 10 houses every month. It takes 3 months to complete, and every month we start another 10. And as we're building them, we're renting them out. So by the time we get to 100 units built out, it's like already 60, 70% occupied. And there's a big difference there between horizontal multifamily, what we call, right, subdivision development, because once the entire building is complete or the entire subdivision is complete, you don't have to do concessions to get renters in and get everybody to, try and get the absorption of the entire building as fast as possible because it's already been rented and stabilized along the way. But these are the essential different phases of development, and the most lucrative ones are in the beginning, but those are also the riskiest ones. So people come in with different objectives at different times. At the end of the day, it's very lucrative no matter what area or what time you come in. In fact, in networking with other developers across the country, I'm running into a lot of people that they only do land. They just love the land. Hey, let me go find some land. Let me entitle it, do some zoning changes, do some things. And then I don't want to develop. I don't want to be a builder. I don't want to operate that stuff. I'll give it to you guys and you guys can take it from here. And some people love that, right? They don't have to do all that stuff. But for us, I think we like that phase, right? So we want to buy at the land phase because we know that we're going to force the appreciation and we like making that money right there. And we feel like we can we believe that we have an understanding of the projects that we're, pieces of land that we're buying so good that we've mitigated all of the risks. So that's why we pay for cash at that stage. And I think we would do the whole thing with our own money if we could scale to that capacity where we're taking down 250 units with our own capital, like family offices are doing, some of them anyways. But the reality is we have to partner with other people. If we want to scale to 10,000 houses in the next 7 to 10 years, we need help. So we're taking on limited partner capital at different phases of development.
Well, it's very strategic joint ventures and partners and LPs, and it's a whole evolution and network, which is really cool. I'm so glad you kind of explained those phases and stages of it, and obviously the kind of the risk according to those stages as well. And I found this interesting, and I was going to ask you this. I'm glad you kind of brought this up. Was the integration on the exit strategy? So, are you exiting? Are you renting these people, putting people in the houses and then, exiting, or is it more, because obviously I would imagine the exit would look a lot, the valuation of that would be much higher because these individuals are, you got 90% of people that are in those new established properties. Is that correct in regards to increasing the valuation because these are already rented, because they already have, customers, et cetera, and that integration on that to increase the valuation of the exit?
Yeah, if you're looking to purchase a business, typically in the real estate space, you want that business to be 90% occupied in order to qualify for traditional financing, like Fannie Freddie financing or whatever kind of financing that you decide to go on. So we like to get it entirely stabilized and then sell it at that point, because you're right, it's worth a lot more because it's got a stable rental income that's coming in every month. There's some developers, their business model is to build. That's where they make their money. And then they just put a bunch of like crappy guys in there, and or not specifically crappy people, but specifically like there's an economic vacancy where people are paying under market rents and they haven't been qualified correctly. So you have kind of a hodgepodge of people that are renting in there, and then they just want to sell it so they can move on to the next deal, and then continue that process of let me build and sell, build and sell, build and sell. That's how they make their money. That's not us. We build, we stabilize at maximum efficiency, at the highest rent that we can, that is comfortable for the people that we identified as our prospective residents, and then we sell the entire asset as one commercial real estate asset based off the net operating income to an institution, that so that it's valued exactly like a multifamily property is. Now, would we like to keep some of these? You betcha. There's probably no better existing asset than a bunch of brand new houses that are cash flowing with extremely low maintenance, and that long-term resident base than the build to rent subdivision space. Maybe there's a couple of things that are very sexy as well, but we really like that space. And if we can build 5 and keep 1, I think we want to do that. Or if we can build a subdivision in a, let's say a kind of area with tax benefits, we'll choose to do so, where if we can eliminate some of the taxes, then we will.
Well, I was curious on this. So let's talk about like the timeline of, start to finish. I know it's very contextual depending upon each deal. Each deal would be drastically different and depending upon obviously the structure of it and the stages. But like what timeline are you looking for in regards to, exiting from beginning to exit? And then as well as like you just mentioned in regards to exiting, the different ways of exiting, right? You don't have to go 100%, sell. You can obviously still have
Yeah.
some equity pool as well as having some say in kind of the trajectory of it. So first question, of course, is that timeline, and second question, of course, is the exit strategies that you guys look at.
Timeline and exit strategies. Okay, so the exit strategies are numerous, right? You can sell the houses individually, which for us, 241 different escrows and sales. I think that would be like a brain damage for us. We could sell them in chunks of 10. We could sell them, half the project. We could sell the entire project, or we could keep the project. So those are all available. We like specifically, if we can, to sell the entire subdivision. So timelines would be depending on which phase you come in it. But let's say that we're syndicating a deal for vertical development. We're telling people that we're expecting to keep this for 5 years. But the reality is, internally, we know that we can build the entire subdivision in 18 months, probably get it stabilized in 24 months. And we're already marketing to an institution that typically takes 6 months to close before the entire thing is stabilized, right? So it's at 75% occupancy. And by the time you're ready to close, it's going to be at 90+% occupancy.
Mm.
And we don't wait until 90% occupancy and then take it out to the market, because we know there's a long period of time for closing for these institutions. So we take that into account. But yeah, so if we tell people, hey, we're planning to get your money back and get you XYZ return in 5 years, the reality is internally we believe that we can do it in about 24 to 30 months.
So yeah, and it's kind of, I definitely understand it in regards to, like, obviously this is your expectation and then beating that expectation naturally. So I appreciate that timeline. And then also, correct me if I'm wrong, what you just mentioned, and I love what you said. When you're looking at exiting, it's not like you wait until 24 months, everything's good to go, and then put it on the market. You're having that dialogue, you're having that conversation, uh, you know, 8, 9 months, down in the actual project as well, and saying, hey, we're at 75% occupancy. Now we're growing that, next quarter 80, next quarter 85, 90, 92 now. And then all of a sudden it's like, hey, this is looking pretty sexy. Ruben, when you're looking at these institutional buyers, is there a strategic individual that you like to deploy, exit with? And what I mean by that, does, mission, vision, values have to align, or is it more of like, hey, as long as the numbers line and they're willing to, spend some money? Or how do you guys like to look at those or underwrite the institutional buyers, in regards to selling and having an exit? How do you guys approach that?
Yeah, we would probably base a lot of that on broker relationships. We know that there's incredible demand from institutions, but we don't necessarily have relationships with all of them. We know that if we were to specifically target people that aligned with our mission, our values, a lot of people on my team are part of a Christian based real estate group. I am not, but there's a lot of emphasis on community and specific things designed to create stickiness within the community, right? Or even some kind of a spiritual basis for it. But I mean, here's been my experience. I've been in business with people that are very spiritual, and then I find out that their communication infrastructure sucks. That in reality they're not getting back to investors. And you think that just because they're spiritual that they're going to be like amazing people to work with, and the reality is that they suck at a lot of things, right? They're just normal human beings. But here's the other thing is when you're trying to specifically align with people assuming that they're going to be and operate a specific way, they may take your property and turn it into a dump or mismanage it after you sell it to them. So you can't, I don't think it's wise in a lot of situations to specifically target people that align with your missions because they may convince you that they have the same values and then reality sets in and they're operating completely different than the things that they said that they were going to do.
So it sounds like to me the way you approach the exit, it's not like, okay, hey, write me a check and I'm out, gone. We've done our project. We got it to this phase and you guys take it on. It's more of saying, hey, I want to sell it to someone that's going to obviously empower and scale this even further and just keep it a class A successful real estate. You want to, yeah.
Ideally, however, when you have a brand new property, it's going to be really hard to drive it into the ground and mismanage it because everything's brand new, right?
Yeah. That
So
makes,
unless you're putting really bad renters in your property, I mean, I can imagine that there's going to be in some situations poor property management, but other than that, I mean, the property is going to be very easy to maintain if you have any level of decency as in your selection with
mhm,
property management because everything's brand new, right?
yeah. When an investor is looking at this deal, okay, obviously the KPIs and what you're optimizing for is drastically different than regular syndicated, multifamily kind of deal. Okay, so you're optimizing for different things, right? So my question is what would be some of the big differences in regards to KPIs or data that investors are most aware of, or they would be asking in regards to, the syndication versus obviously, built to rent.
Yeah, I think most people they're just like they see conceptually that built to rent is coming. It's sexy. There's a lot of demand for it, but they just don't understand it, and I think they want to. Right? I don't think that when you think of it buying an apartment complexes, it's too complicated philosophically to invest your money with it because you understand that hey, you take good care of the residents, you do good things to improve the property, the net operating income will be improved. And if you can make it more efficient by lowering expenses, it's a very kind of basic, it's way more complex than that. But philosophically speaking, it's kind of easy to understand. And people want things that are easy to understand. And as soon as they dive into development, oh, well, there's all this zoning. Like, what if I want to? And then there's a lot of limited partners. They get into multifamily because they eventually want to become active. And like that barrier of entry is huge if you're getting into development, right? Because you have to learn everything if you're going to become a developer. And there's so many things that you're going to miss if you try and do it yourself. So I don't know that it's great to try and get into this space if you want to become a master of it and operate and build yourself. I think it makes a lot more sense to partner with people that have already done it if you want to get into development and just kind of scale with them and then help them improve their efficiencies. And then as you get better, you can kind of take that skill set and apply it and start building yourself. But for people, there's a lot of people that are, I built a couple of houses. I want to build subdivisions now. And they're in for a big rude awakening about all the things that they're going to find along the way. So I definitely recommend partnering with somebody that's built a subdivision or that can prove to you that they have the capacity to do so, and then align very closely to the business models of other huge developers that are already in the same markets, right? So you want to follow the DSLDs and the DR Hortons of the world and do something similar to what they're doing in the same markets where they're doing, right? Like you don't want to put a Burger King where there's not already a McDonald's. So don't go into some market where nobody's ever built a subdivision and try and put one there, right? So think about those things before you get into development and make sure and align yourselves with the right people that can help you get to your goals.
Well, that's why I wanted to have you on, Ruben, because you're able to unpack that for our audience and for myself. And what's interesting is I've got a lot of friends that have made a lot of money in one vertical, right? Maybe tech field, and they're sitting on a big, chunk of change, but they don't know anything about, real estate, different verticals. And it's so interesting because you can lose money very quickly if you don't know what you're doing. And so I'm a big believer in what you just mentioned in regards to finding the right players, underwriting the people that you're going to collaborate with. Hey, what is their experience? What is their, results? And obviously you guys have done very well for yourselves and obviously scaling up to the right trajectory, even in a crazy market at a macro economy. So, Ruben, I really appreciate you being on here,
It's
man.
been so fun.
For those that want to reach out to you, I know you obviously have the Capital Raisers show. How else can they reach out, get engaged with what you got going on, and follow your content, my man?
Yeah, I like LinkedIn right now. You can find me on all social media platforms, but LinkedIn is my preferred, probably where I'm most active. They can find me anywhere podcasts are played with, just look up the Capital Raiser Show. And if they're interested in our developments, they can check us out at legacyacquisitions.com.
Awesome. And guys, all those links, just to make it simple, are in the description below. So make it simple. You can click and reach out and engage with Ruben and what he's got going on. Ruben, again, I really appreciate you being on here. I always love to ask my guests before I let you go fully. I think about, obviously you've done very well for yourself. You've been able to build amazing relationships and network and very successful what you've done and still hitting that trajectory. But if you could think about that young Ruben, okay, that young, naive individual, didn't know what he was doing, where he was going, but now you're into this new Ruben. What insecurities did you have to overcome to become the successful Ruben Greth you are now?
Fascinating question. There's a lot of ways that I could approach that. But I don't know that I would change anything, right? Because then you're starting to potentially compare yourself to who you could have been or compare yourself to others. And that's not it's not good for your self-esteem, right? So there's people that came into multifamily syndication at the same time or almost the same time as I did. And they own $1 billion worth of assets and they live in the same city as me. And like when I try and say to myself, how come I don't have $1 billion worth of assets? And how come I didn't scale like them? Then that's self-defeating, right? So I would say like just stay on your trajectory and everything will be fine. Because I did have a lot of insecurities. Like I didn't even realize I had the skill set to be a podcast host, but it's not as complicated as I thought because you just make friends with people and then keep it simple. But I would go back and say one thing to my younger self: don't sell your real estate. Right? Like if I could keep the stuff that I bought in 2009 and 10 and 11 when things were at a fire sale, like buying stuff ridiculously cheap for 20,000 a unit here in Phoenix, that's now worth 150,000 a unit. Man, I would definitely go back and say, hey, before you sell, I know it makes sense and it's lucrative to flip your properties and things in the market, and you feel like you've arrived, but just hold on to as many of those as you can, right? Because property is going to be worth more down the road.
Well said. Well said. Guys, that is my guest, the managing partner at Legacy Acquisitions, the one and only, the host of Capital Razor Show, Ruben Greth. Guys, that is the Journey with Christian D. Evans podcast. Until next time, be uncommon if you can.